डॉक्टर बाबासाहेब आंबेडकर ओपन यूनिवर्सिटी.
Hello my dear student, I am welcoming you to all in the video lecture series of the Dr. Babasaheb Ambedkar Open University in Chaitanya Studio. Today we are discussing for the course of BBA regular in the paper number 202 Financial Management, Block 1, Unit number 2, Long-Term Finance. Now let's begin our journey with discussing the long-term finance. In a previous session, we discussed about what is finance, what is financial management, how it will be work, how it will be useful for a company, for a business, for a proprietorship, or for anything in a life. For this purpose, we discussed at that point of time there are two types of finances. First is long-term finance and second is short-term finance. In today's session, we discuss the long-term finance. Now question is, sir, we discussing the long-term finance, but what are the learning objective for it? So there are the few learning objective for studying this particular chapter called a long-term finance. First, the need for a long-term finance. Second, the important source and the type of long-term finance. Then the feature of equity capital, preference capital, debenture capital, term loan, convertible debenture, warrants, etc. Then we differentiate between the all source of capital. Then discuss the risk and return ratio of the different sources. So these are the few learning objective of particular this chapter called long-term finance. Now let us begin our session with the introduction portion. That is, in India is a grip to achieve 8% growth per annum, and any economic need finance to grow the finance is called the lifeblood of the business. The company need a finance for the mainly for the two reasons are that. First, to meet the long-term requirement, and second, to meeting the day-to-day requirement, that is working capital, that is called a short-term finance. So ultimately we can bifurcate it into the two ways, that is long-term finance and another is a short-term finance. Then the long-term decisions of the company include to setting up the business, diversification, modernization, expansion, and such capital expenditure decision, which is mainly covered under the capital budgeting. Next is, company should be prudent in the meeting of the long-term requirement by long-term sources of funds instead of the short-term sources of fund. Then if there is a done otherwise meeting of the long-term requirement by short-term sources, then there would be the mismatch and this would lead to the interest rate risk and interest burden, and the company will have to face the liquidity risk eventually. So ultimately, my dear friends, you have to take a step in a very precise manner for a long-term decision. If you are not taking such decision in a precise manner, at that point of time, your business or your company must be in a risk situation, and your burden of interest and the burden of risk of interest is increases day by day, and ultimately it will face to the your liquidity risk eventually. So this is the basic introduction of long-term finance. Now let's move on to the types of capital. Now as we discuss the long-term finance, so there must be few capitals are there. As we are discussing the learning objective that we are distributing or differentiate the different capitals, so we have to learn first of all that what is the capital and how are this capital is used in a finance, and ultimately how many different types of this capital are there. So first, the company can issue mainly three types of capital, that is equity capital, preference capital, and another is a debenture capital or debt capital, or we can say the loan capital also. These sources distinguish among themselves on the risk, return and ownership pattern. So my dear friend, here we discussing the company divided or distributed their capital in three ways, that is equity, preference, debenture, debt or loan. Another is, and ultimately in these three ways, ultimately they are dividing the risk, return and ownership pattern. So ultimately the company require this three type of capital and they eventually distribute their risk, return and ownership pattern amongst them. This chart is ultimately show that the different sources and the how they will be the at the seed stage, startup stage, company level and exit level. Now here the few differentiate are there, that is a personal saving for a seed state to startup, family loan seed to startup, government seed stage to exist level, then mortgage and leasing to startup to company level and exit level also, then bank loan, venture capital both from the exit level, then stock exchange ultimately company to exit. That means it ultimately differentiate between that particular company also. So that's why in that BSC and NSE play the key role. So this chart is ultimately show that the how the different stages and different companies are there to evaluate that particular finances in a long term basis. Now moving towards the and elaborate the and discuss the different types of the capital, then here I distributed and discuss the different types of capitals are there. So in that, first is equity capital, second is preference capital, third is debenture capital, fourth term loan, then convertible, warrants, leasing, hire purchase, initial public offer, it's called IPO in a short form, then right issues and private placements. So my dear friends, these are the different types of capital. So now question is in your mind that sir, as you are discussed earlier, that is company divided that capital into three ways, that is equity, preference and debenture. So why we are learning this much? Yes, you are right my dear friend. We have to learn. Why? Because company ultimately differentiate that capital into three ways, that is equity, preference and debenture. But in that way there are the different transactions are there and there are the different sources are there that we have to learn with this particular evaluation of the long term finance. So we have to evaluate this particular types of the capitals. Okay, now let's move on to the first discussing point, that is equity capital. The equity shareholders are the owner of the company. After paying a part profit to the preference shareholders and other creditors of the company, they enjoy the residual profit of the company. So we can say that the shareholder, the equity shareholders are the ultimately the owner of your company. Then their liabilities is limited to the amount of share capital they contribute to the company. Then the benefit of the equity capital to the issuing the company is that without any fixed commitment for the payment of dividends, and it offers the lifetime capital with limited liability of for the repayment. Then we can considering the cost of capital and the cost of equity capital is a higher than any other form of capital. Now question is, sir, which other form of capital? So first is the equity dividend are not tax deductible expenses, the high cost of issues, then the equity shareholders enjoy voting rights. So excess of equity capital in the company's capital structure lead to dilution of the effective control. So ultimately I can say that the equity shareholder has the more power rather than the different shareholders. Now let's move on to the preference capital. The preference capital combined the attributes of equity shares and debentures. Like in a case of equity shareholders, there is no mandatory payment to the preference shareholders and the preference dividend is not tax deductible. unlike in the case of debenture holder wherein interest payment is mandatory. Then the most preference share in India carry a cumulative dividend features, that is requiring that all past unpaid preference dividend be paid before the ordinary dividend are paid. In the India, there is both redeemable and perpetual preference share can be issued. The perpetual or irredeemable preference share do not have the maturity date. The redeemable preference shares have a specified maturity, and in India, the redeemable preference shares are not often to retired in accordance with the stipulations, since there are no serious penalties for the violation of redemption features are there. So preference shares may or may not be convertible. A convertible preference share permit the preference share to convert their preference shares into the fully or partly into the ordinary share at a specified price during a given period of time. That means it may be convertible, it may not be convertible. Okay. Then the preference shares allow more flexibility and the fewer burden to the company. The dividend rate is less than that the equity share, and it is a fixed rate. There is no change in a dividend policy or dividend rate. In the addition, the company can redeem it when it does not require the capital. And then normally when the company reconstruct its capital, it may convert your preference share capital into the equity capital. And occasionally the equity capital may be converted into the preference capital. For example, IDBI in 1994 proposed to convert its own equity capital as a preference capital. That was a history, that equity convert into the preference, but in a normal case the preference convert into the ordinary share or equity shares. Okay. Next is debenture capital. Now this debenture capital or a debt capital or a loan capital, the third most important category of the types of capital for the company, while they are distributing their risk, return and ownership pattern amongst them. Okay. So last and important point for the evaluation of the company's types of capital, there are mainly the preference share capital, then equity capital and debenture capital. We discussed the equity capital, then preference capital. Now we are move on to the debenture capitals. Okay. So let's start our discussion with the debentures capital. The debenture is a marketable legal contract whereby a company promises to pay its owner a specified rate of interest for a defined period of time and repay the principal at a specific date of maturity. A debenture is a long-term promissory note for raising the loan capital. That's why the other name is the loan capital or debt capital or debenture capital. The debenture are usually secured by a charge on the immovable properties of the company. If the company issues the debenture with a maturity period of more than 18th month, then it has to create a debenture redemption reserve account or DRR, which should be at least half of the issue amount before the redemption commences. The company can also attach the call and put option also in that particular situation. The interest rate on debenture is fixed as the preference share capital and known for it indicate the percentage of the par value of the debenture that will be paid out annually or semi-annually or quarterly in form of interest. That means as per the preference share capital, the dividend rate is fixed, and in this particular, that is debenture capital, that interest rate is fixed. The debentures are issued for a specific period of time, and in India the debenture is generally redeemed after 7 to 10 years in an installment. That means that ultimately the specific period of time and debenture generally redeemed after 10 or 7 to 10 years of the installment. That means that you have to wait till the 7th year is not completed. There are the few different types of debentures are there. In that, the debenture can be classified based on the conversion and security. A few types of debenture are discussed below. That is, first, non-convertible debenture, fully convertible debenture, and partly convertible debenture. In a short form, I can write that NCDs, FCDs, and PCDs, which is treated as a non-convertible, fully convertible, and last is partly convertible debentures. Moving towards our journey of the types of capital, let us understand the different advantages of the debentures, or we can say the debenture capital, the advantage and disadvantage of this different types of capitals are there, and debentures capital. The first advantage is debenture is a cheaper source of finance because investors consider debentures as less risky investment and therefore require a lower rate of return. That means we can consider it with this particular advantage, the equity shareholder or equity capital have the more risky as compared to the preference and debenture capital. Next, the interest of payment and tax deductible ultimately. Then, since the debenture holder do not carry the voting rights, the debenture issue does not cause the dilution of the ownership. Then debenture holders do not have the share in extraordinary earnings of the company, so the payment are limited to the interest. In the period of a high inflation, debentures issue benefits the company and its commitment of paying interest and principal, which are fixed, decline in real terms. So these are the different advantages are there for the debenture capital. Let's move on to the disadvantages of debentures. The debentures carry the legal obligation of interest and principal payment, which if not paid can force the company into the liquidation. That means if the legal obligations are that, then you have to remove that obligation, and then after you can use the debenture in an effective manner. Otherwise, the company must go into the liquidation process. Then, in the case of the companies which have the fluctuating sales and earning, the debentures prove to be disadvantageous due to increase the financial leverage. Then at the time of maturity, the debenture involve substantial cash flows also. So these are the different disadvantages are there. For that, I can say that you can learn in a different ways. That is, different sources are there that we discuss in the next session. For the today's session, let's sum up with the today's session that what we learn. So we learn that the different types of capital. The first is introduction part, then different types of capital. In that, equity capital, preference share capital, debenture capital, term loan, convertible, warrants, leasing, hire purchase, initial public offer, right issue, private placement, etc. In that, we discuss three major points, that is equity capital, then preference share capital, and debenture capital. And these three most important. Sir, why this is most important? Because the source of this distinguish among themselves on the risk, return and ownership pattern. That means कि three main capital for the company, that is equity, preference and debenture capital, and there are three main sources distinguished among them, that is risk, return and ownership pattern. Amongst that, we discuss this particular chart, then we discuss the equity capital, debenture capital and preferential capital. In the debenture capital, we discuss the different types of debenture, that is convertible, non-convertible, fully convertible, partial convertible. These are the different types of the debentures. Then after, we discuss the advantages of debentures, then disadvantages of debenture. For the further reading, my dear friends, you may exercise this particular book also. You may go for the reference book also, that is financial management, that is by the ICFAI, then financial management by the IM Pandey sir, then financial management G Sardaran sir Reddy, and financial management of fundamentals of financial management for the BBA Vinit Mehta by the B.S. Shah Prakashan. So you may learn it from this particular reference books also. So thank you very much, my dear friends. Hope you learn it in an efficient manner. We will meet in the next session for the discussing the different types of capital. Thank you very much, my dear student. We will meet in the next session with the new topic. Thank you.